Welcome, viewers. Welcome to Economic Merit Report. Today we have before you Austria, concluding statement of the 2024 Article 4 mission, published in imf.org, spring budget predictions, published in taxjournal.com, and report to shareholders for the first quarter 2024, published in insurancennewsnet.com. We take each publication one after the other. Stay tuned. Austria, concluding statement of the 2024 Article 4 mission. The International Monetary Fund, IMF, recently conducted an Article 4 consultation with Austria. The IMF mission, led by Kevin Fletcher, visited Austria from February 16th to March 1st, 2024, to discuss the country's economic outlook and policies. The mission issued a statement highlighting the following key points. 1. Nimble policy responses have helped Austria mitigate the effects of major shocks in recent years, such as the pandemic, energy price shock, and rise in interest rates. However, these shocks have weighed on growth. Looking ahead, Austria's growth is expected to gradually strengthen during 2024-25 while inflation declines towards its target. To maintain macroeconomic and financial stability and prepare for strong sustainable growth, policies should focus on A. Undertaking well-designed fiscal adjustment measures to support disinflation, rebuild buffers, and address spending. Pressures from aging population, climate change, and other needs. B. Conserving bank profits to strengthen buffers against risks and closing financial sector data gaps. C. Advancing structural reforms to boost labor supply, increase housing supply, accelerate the green transition, and enhance economic resilience and productivity. Recent economic developments show that nimble policy responses have helped Austria rebound strongly from the pandemic. However, high energy prices and tighter financial conditions have led to weaker growth in mid-2022 and a contraction of 0.8% in 2023. Growth is expected to gradually recover with an expansion of around 0.5% in 2024, supported by rising real wages and further momentum during 2025-26 as effects of monetary tightening fade. Labor markets remain strong despite weaker growth with record-high employment rates and moderate unemployment rates. Headline inflation is expected to fall gradually towards the target by mid-2025 due to declining energy prices, but core inflation remains elevated due to sticky services inflation. The baseline outlook is subject to important risks, including upside risks from stronger external demand and downside risks from trade disruptions and shocks to global commodity markets, especially gas. Domestic risks include an abrupt correction in housing and commercial real estate markets. Fiscal policy should seek opportunities to overperform on the deficit target for 2024 and focus on steady consolidation over the medium term. Fiscal adjustment measures are needed to offset rising spending needs and put the public debt ratio on a clear downward path. The financial sector in Austria has been stable, liquid, and profitable. Banks should use high profits to strengthen capital buffers and improve protection against adverse shocks. Prudent lending standards for residential real estate should be maintained, and close monitoring of commercial real estate risks is warranted. Structural reforms are needed to address growth challenges from demographic headwinds, boost labor supply, secure the green transition, and strengthen economic competitiveness. The IMF mission expressed gratitude to the Austrian authorities for their constructive policy dialogue and collaboration during the consultation process. That is the end of what you need to know about Austria. Concluded statement of the 2024 Article 4 mission, published in imf.org. Moving on is Spring Budget Predictions, published in taxjournal.com. Spring Budget Predictions. The spring budget, which is expected to be the last major fiscal event before the next general election, will likely focus on potential vote-winning measures. Despite warnings from the International Monetary Fund, IMF, the Chancellor has suggested that there may be room for further tax cuts following the national insurance changes announced in the Autumn Statement 2023. Personal tax giveaways are expected to take center stage, while measures aimed at businesses and reinforcing the government's economic growth narrative may take a back seat. Lower than expected public borrowing and an economic recovery later this year are likely to give Chancellor Hunt scope to cut taxes again on 6 March. The size of the tax cuts will depend partly on revisions to the Office for Budget Responsibilities, OBR, economic projections. Lower inflation, lower interest rates, and a stronger outlook for growth will help in this regard. However, there is a possibility that the OBR's forecast of doubling productivity growth may be downgraded, which could hinder the Chancellor's aim to cut taxes. Nevertheless, it is unlikely that these forecast changes will prevent Mr. Hunt from cutting taxes. To meet his main target of reducing the debt-to-GDP ratio in 5 years' time, he may simply include unspecified spending cuts in the next Parliament. The reaction of the Monetary Policy Committee, MPC, and financial markets is a concern for Mr. Hunt. Mortgage rates have fallen sharply in recent months, and at its February meeting, the MPC signaled that interest rate cuts were likely to happen this year. The Chancellor would be hesitant to sacrifice any popularity gained through expensive tax cuts by being blamed for a resurgence in interest rates. The Chancellor may propose a tax-cutting package similar in size to the one announced in the last autumn statement, but with an even greater focus on reducing personal tax burdens. This would make a splash, but not enough to trigger action from the MPC or spook financial markets. In terms of income taxes, it is likely that there will be cuts to income tax, potentially through increasing the personal allowance and/or basic rate tax band, or by reducing the basic rate. Alternatively, the Chancellor could follow his approach in the autumn statement and further cut national insurance contribution rates. The personal allowance and higher rate threshold have been frozen since April 2021, but with inflationary increases they would now exceed $15,000 and $60,000 respectively. Increasing the personal allowance would benefit those with lower incomes, while reducing the basic rate or increasing the basic rate band would provide greater benefits to higher earners. Inheritance tax, IHT cuts, are unlikely to be as significant as previously rumored, with most tax cuts expected to be directed towards the working population to encourage economic growth. Smaller changes, such as increasing allowances or a pledge to reform or abolish IHT following the general election, seem more likely. Business taxes may not see significant changes in this budget, as most voters are not directly impacted by them. However, progress updates on investment zones policy, global minimum tax plans by OECD, and technical changes to capital allowances and R&D tax regimes are expected. To stimulate the property market and help first-time buyers, there may be extensions of stamp duty land tax, SDLT, relief and financial support. Reform of SDLT reliefs on transactions involving mixed-use properties and multiple dwellings is also expected. Changes to individual savings accounts, ISAs, may be announced in response to calls for further simplification. Increasing the threshold for lifetime ISAs for first-time property buyers and reducing penalties for exceeding that threshold could be considered. The Chancellor is likely to build on previous announcements regarding tax simplification and may outline next steps and proposals for simplification arising from recent consultations on employment taxes. Changes to the High-Income Child Benefit Charge, HICBC, may be made due to its unfair impact on single-earner households. Radical reform or an increase in the threshold above which the charge applies are possibilities. If the Chancellor's appetite for tax cuts exceeds available headroom, he may look to raise additional revenues from non-domiciled individuals, non-doms, and non-UK residents. Tactical tweaks to the non-dom tax regime or increasing the rate of the non-resident SDLT surcharge are options that could benefit the current government while limiting future changes. Overall, the spring budget is expected to focus on personal tax cuts, with potential changes to income taxes, inheritance tax, business taxes, SDLT, ISAs, employment taxes, HICBC, and non-dom tax regime. The Chancellor will need to strike a balance between stimulating economic growth and ensuring fiscal responsibility. That is the end of what you need to know about spring budget predictions. Lastly is report to shareholders for the first quarter 2024 by Insurance Newsnet. Report to shareholders for the first quarter 2024. CIBC announced its financial results for the first quarter of 2024, reporting a 5% increase in revenue and a 299% increase in reported net income compared to the same period last year. Adjusted net income decreased by 4%, while adjusted pre-provision, pre-tax earnings increased by 8%. The reported diluted earnings per share increased by 354%, while the adjusted diluted EPS decreased by 7%. The reported return on common shareholders' equity, ROE, was 13.5% compared to 3.1% in Q1 23, while the adjusted ROE was 13.8%. The net interest margin on average interest-earning assets was 1.43%, and the CET1 ratio was 13.0%. The results were impacted by various items, including a charge related to the special assessment imposed by the FDIC on U.S. depository institutions and a recovery to income tax that would be eliminated by a federal proposal. CIBC highlighted its success in executing its client-focused strategy and attracting and deepening client relationships. The bank also made significant donations to children's charities, established scholarships at Concordia University, and increased its donation to the Christine Sinclair Foundation. That is the end. Thank you for listening. Till next time.